Good afternoon, everybody. It's Brian Shannon here from alphatrends.net. Today is Monday, December 1st, 2014. First, thanks for all the well wishes for the wedding over the past week. We have this market back gap down a little bit today and continue to sell off, down slightly, about two-thirds of a percent actually. We've known that this market was getting extended and we've been cautious about not chasing. And this is the first close we've had below that 5-day moving average since this October low, and we had become bullish once again as it got back above that 5-day moving average. So now we have a pattern in here where we've broken some important support. That support is also where we see the now declining 5-day moving average, and that says the light has turned on the intermediate term from cautious to negative now. What would change that is if we get back above about 207, 207 and a quarter. That's going to be our important band of resistance that we need to overtake in order to become bullish once again. So for now, it doesn't mean rush out and sell everything short. Instead, it says, expect some further pullback. We've had this fantastic rally here, and again, this is where we had originally seen that higher high above the flat to rising 5-day moving average. Well, now we see a lower low below a flat to declining 5-day moving average. So that says that it's time to become much more cautious. Now, it doesn't mean we get aggressively short because we still have an advancing 20, 50, 100, 150, etc. Moving averages. So the primary trend still remains higher, but we just get cautious in these environments and wait for the evidence that the buyers actually do take control. If you're looking for shorts, then shorts, let's say below this little pennant that formed here today with a stop above 206.50, that may be a good trade for tomorrow. But again, it's higher risk because the primary trend is still higher here. So for today, we had a choppy session. It gapped down and really didn't do a whole lot from there. We did stay stuck below the daily S2 level and closed just around that volume weighted average price. So it seems that it definitely makes a lot of sense to become very cautious here. We had 2,400 declining stocks and just 700 advancers, so more than 3-to-1 negative there today. The NASDAQ was down $1.20 or 1.13%, and it came down to the rising 5-day moving average. Now, as I mentioned on Stock Twits earlier today, because we're at a 5-day moving average doesn't mean it's time to buy. And I was talking and used a good example with Facebook, that Facebook looked like it was finding support at that rising 5-day moving average. But when we dug deeper into it, you can see here's where that 5-day moving average was. This is today's action here. We were still making lower highs and lower lows below a declining volume weighted average price. So the 5-day moving average said, okay, let's start to look for evidence that the buyers are actually gaining control. If they do, then perhaps we could get a little bounce trade. But instead, what happened there was we remained below that volume weighted average price, which was declining, and told us there was no reason to purchase. And that's the same interpretation that I see here in the NASDAQ, that we stayed below, at least closed below that volume weighted average price here today. And we've had a fantastic rally over the last month and a half. It would be normal and expected and reasonable to see that perhaps some of these trend lines get tested. Maybe we head down towards 104. That doesn't seem to be a big stretch here. It was prior resistance. It has the potential to become support. It seems as though the market is more likely to decline a little bit further from here. And I think that for the NASDAQ, it's not as bearish as the S&P 500 because we are still holding at that 5-day moving average, and the 5-day moving average is still rising. It's telling us now's time to be very cautious. The Russell 2000, of course, on Friday is the one that broke this 5-day moving average, and we gapped lower today. Now we have a clear pattern of lower highs and lower lows below that declining 5-day moving average, and we back out to a 30-minute time frame. This was the important level last month, 114 and a quarter basically to 114 and a half. If we find support there, then we'll look for evidence that the buyers are actually gaining control. But right now, let's just let it settle in, see if it finds buyers there, if it maybe continues down a little bit further and perhaps test that 50-day moving average. Again, though, we need some work to be done before this market can turn back to the upside and be considered reasonable for an intermediate term trend to the upside. Semiconductors were down slightly today as well, down 1.1%. They're still clearly above that rising 5-day moving average. I don't think they're a buy above it. As we say, you have to look at it and say, where has it come from? Where does that have the potential to go? What's the rest of the market environment? And the rest of the market environment is we're pulling back a little bit. Today, the semiconductors did close below that volume weighted average price as well. So it's telling us perhaps we're going to see a little bit further pullback. To me, the obvious level of a bigger area of potential support would be 54 to 54 and a quarter. If we were to break down to that level, rally up to the 5-day moving average, the 5-day moving average flattens out, and then we turn lower, then I think that we could be in for a little bit deeper pullback, and that might actually be a decent scenario that would get us down towards maybe this prior resistance level. But for right now, it's saying be cautious. We're below the declining volume weighted average price. That's 1 day's price action. We also are below the 2-day volume weighted average price. So that's important because this was a big up day right here. But I think pulling back down to 54 at a minimum seems very reasonable here. And if you're going to short it, you have to be very flexible and ready to move to the sidelines if it turns the other way. As we saw with oil today, some of the biggest bounces come within a primary downtrend. Financials were down 18 pennies today. They've kind of broken a little bit of support in here, but this 24.10 to 24.20 has really been a level, and I think even down towards 23.95 to 24 is the bigger potential level of support. To come back down and test that level does not seem unreasonable to me. This market had broken out, and perhaps from this failed breakout, at least failed for 1 day, we're going to see a little bit of further pullback and test down towards that $24 level, 23.95. Interestingly, gold is really kind of doing what I've been calling the best case scenario for gold and the gold longs. We spoke about this Russell 2000 back in here, how it had entered a stage 4 decline, and at that point we were calling it guilty till proven innocent. Well, as it showed that it was able to recover back up and trap these short sellers in here and have a bunch of longs throw their positions away, from that failed move lower came a fast move higher, and I think that that's what we're seeing set up here in gold. I'm nothing close to resembling a gold bug. In fact, I really don't like trading gold at all, but I do think that this was a decent little shakeout below this, what people were calling a triple bottom, and as I've said, if they don't scare you out, they'll generally wear you out. I don't think that this is a huge trade, but I think, now that we've recovered back up above that 115, 116 level, we've been talking about this for the last 2.5 weeks. Now that it's done it, I think that this is, the gold could probably be bought with a stop underneath this level here at about, let's just call it 111.75. It looks like it's able to continue to move higher, and I'd mentioned that to subscribers right in here this morning, that looking like it has the potential to do that failed move on the weekly chart that could lead to a faster move higher. Perhaps it heads up, towards the 200-day moving average up near 122 or so. I don't think it's the beginning of a major bull market, but I think you see that a lot of shorts got trapped under there. A lot of longs kind of puke their position, and that often leads the way from failed moves come fast moves. Let's talk about Apple real quick. Apple pulled back today, and this stock, for the first time really since it reported earnings, let's just add some days here to get a better look at it. Since they reported earnings, the stock had gapped up above that 5-day moving average and been making higher highs and higher lows, closing above that rising 5-day moving average. Well, it broke some support here at 117.5 and continued lower. And I think that if you're looking to purchase Apple right now, what you should be doing instead is saying, if you bought it anywhere in here, you should be stopped out and looking for the next level. Give it some time to settle down. Nobody knows where that will be, but it's had a massive rally, good-sized rally, 25 points here over the last month and a half. Certainly pulling back down into 110-ish doesn't seem like an unreasonable thing. The fact is we have a declining 5-day moving average, and right now we have this prior support at 117.5-ish that is where I would, if you're a counter trend trader who's trying to short this thing, worst case stop would be up there. But I think instead, cash is better to be be on the sidelines in cash. It's, the primary trend is higher. That means the sum of the rallies is always going to be greater than the sum of the declines, unless you're smart enough to pick the top. And of course, people have been trying to do that unsuccessfully. So just let the trend be your friend. Deep breaths, no stress, as Lars, the scuba instructor down in Cancun, said. So it's it's looking like it just needs to pull back some, settle down, and it will tell us when it's time for another low risk, high profit, high probability entry.